Welcome back to your personal bank show. And like I said, we've been talking about a little bit about what is your personal bank and positive arbitrage. And again, what your personal bank is really quite simple. It's a financial concept where we're taking strategically integrating a bank product with an insurance tool to create, well, growth on funds, even when you access those funds for other purposes. Now this gets really, really interesting and really important, because we all have expenses pretty much going out. We have regular bills, those kinds of things. What if you could earn interest on that money you spent? What if that interest was 2-3%? Positive arbitrage. I'm going to use an example here in a minute, but I want to finish this thought. Again, the policy that we're using is not like the typical insurance policy most people are familiar with. In fact, very few people that I talk to when I meet with them have ever looked at or seen anything like this. And again, it's designed to maximize cash growth. It happens to be tax favored also, gross tax deferred, and I'm going to show you how to access the funds and tax free. So that's very important. And like I said, the rates, we've got companies right now that are paying over 6% today, and have every year. I can show every year since 1996, show you the charts. And frankly, I've never missed a dividend payment in over 100 years. Some of them even before the Civil War. That's how long these companies have been paying out these dividends on a consistent and regular basis. Now understand, there's other options I can go with indexing. We have an index option right now where you can fund into the S&P 500, and your returns are going to be somewhere between, with a 1% floor to a 14% cap. What does that mean? Each year, you're in the S&P 500, your account's going to grow between 1 and 14%, depending on what the underlying index does. It's pretty much that simple. And so for folks that want to be in an index and want to see some potential growth, but like the idea of having some downside protection, having that floor, that's a great option. And we can do this positive arbitrage with that too. And then again, there's a third option for more, I always call it the higher flyers, the folks that really want to see some returns. It's the performance factor, we call it. And there's a performance factor that enhances your returns. Typically, it's 2.7 times what the underlying index is invested in, or what's credited for, I should say. And really, the thing is this: if your index, typically S&P 500 or international indexes, there's various options. If your index credits 10% that year, for example, you're going to get a 27% return minus a fee. So the fee right now is 7.5. That's to maximize the returns, to enhance the returns, the performance factor, as I said. The reality is, what's happening? That example, you're doubling the index, doubling the return of the S&P 500 index, for example, with a floor. Again, the principal is guaranteed. If the market goes down or the indexes go down, you don't lose. There's still the fee, so your downside floor is 7.5. So as I say to people, look, if you're interested in taking on a little bit more risk, you have the upside potential of literally doubling the returns on the indexes in good market years, and in bad years, your worst case scenario is a negative 7.5. This might be a good fit for you, and we can create the positive arbitrage on that also. So it gets very interesting. So it's twofold here. So one is, yes, it's about, there's returns. Do we like the steady, consistent 6+%? Do we want to do an index where we can get 1 to 14 each year, depending on what the S&P does? Do we want an index or a situation where we can double the index returns on good years and have a 7.5% floor on the down years? Okay, any of those work. But then here's the other part of it, is the bank line of credit. So there are a handful of banks out there. I've done a lot of research on this, a lot of due diligence. Those of you who don't know, and you probably hear from the show, I'm chairman of the board of a bank in formation, which means we're trying to start a bank. We had actually hired a bank president, and we're getting ready to submit our application to FDIC in March, and of course COVID happened, so it's put everything on hold indefinitely. And so I really needed to research and find some good strategic bank partners, which I have done, thanks to some connections in that area. And so we have banks they'll offer a line of credit based on the cash of the policy, and it can be anywhere from 70, depending on the type, up to 75 to 95% of the cash value. So for example, if you had 100,000 cash in one of these policies, okay, if you're taking the steady, consistent option, it's going to get credited over 6% currently, and has for every year since 1996 and before. But when you access the funds from the line of credit, this is where it gets interesting. we've got the rates on the current lines of credit on those right now is in 3 to 3.95 range. So in the threes, depending on how much money we're dealing with and which company, okay? So what happens? You put money, you can, if you've got bills and expenses, as most of us do, you can pay those bills or those expenses outright, or you can fund them into one of these policies and then access the funds through the bank line of credit, pay those bills, those expenses, whatever they are, and pick up 2 or 3% interest, positive arbitrage. You see, when I share this with real estate investors in particular, they jump on it and understand it almost immediately in most cases, because real estate investors understand positive arbitrage. They're borrowing funds strategically to make more. So I have fun working with them. I have a number of them as clients, a lot of them, frankly, and a lot of different business owners are familiar with and comfortable with positive arbitrage. Here's the thing with this. The underlying asset has guarantees. It's not going to lose, like I said, it's principal guaranteed if you're doing the index option, and if you're doing the steady, consistent option, of course, you're earning an interest rate every year. The contractual minimum, by the way, is 4%, so you know you're going to make 4% every year. Now, the companies, I don't even think they've ever paid that low of a rate, okay? Certainly not in the last 25 years, okay? And I can show you the documentation if you want to contact us at yourpersonalbank.com. Be happy to send you that information, and we can discuss this further, answer any questions you have. But the thing is, by picking up positive arbitrage or interest on money expenses that you're paying, this can change your financial picture in a very big way. Let me give you a couple of examples that I dealt with just this past week. So one, this gentleman's a consultant for businesses, a very successful consultant and in his field. And as I was talking to him, I said, let me ask you a question. If you were consulting a business and let's say their top line profit was 10%, in other words, that was their profit margin. In your field, would that be a pretty good profit margin? He goes, oh, absolutely. Pretty much any business in my field would be happy with that. I said, okay, excellent. Now, if they've got, like any business, they've got income, they've got expenses. Every individual, individually, we have that too. From our financial standpoint, we're like a business, aren't we? We have income, we have expenses. So I said to this consultant, I said, look, the business can continue to operate as it does with income coming in, paying its bills as they go out, expenses. Or they could flow some of the monies through here, this personal bank, put it in the policy, and then access it through the bank line of credit. Now in this particular situation, I was showing them where they would earn 6.1 credit and then access the funds at 3% through the bank line. So the positive arbitrage was 3.1%. This was just this week. I said if we added 3% profit to the bottom line, the top line profit for this business, would that make a difference? And his response was, oh my God, that would be huge. That would be a 30% increase in profits, top line profits. I think most businesses would be pretty happy with that. And I have a number of businesses that do this and operate this way. I want to be able to share you another example we used with a couple with a mortgage that just refied their mortgage very recently, in fact, yesterday. And I'm going to talk about that in this next segment. What I want you to understand is it's about control of your money, and it's a basic financial literacy key. Two keys we're dealing with here. One, building long-term financial success, wealth, involves not only how much you earn, but also how much you spend. And you have to have that positive, you have to have more coming in or your money growing more than it goes out over time to build that wealth. That's pretty obvious. But the other financial literacy key that's important here is who's controlling the money. If you pay a bill, if you take money and you pay an expense with those dollars, will you ever earn interest on those dollars ever again? Will they ever grow for you ever again in the future? And the answer, of course, is no. You paid the bill, you paid the expense. That money's gone. It's now in someone else's control, right? Well, again, what if you could use this positive arbitrage and pay that bill, pay that expense, yet pick up 2 or 3% interest? What if you did that on every dollar you spent? How would that change your financial future? We're going to talk about that in the next segment, so stay tuned.